Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to the In Conversation With series, a series where I speak to notable figures in the realm of financial services. Listen as they share their personal journeys, thoughts on the industry, and advice for aspiring advisors. Join us at Money Marketing Interactive Leads on Thursday, 11th May. Just go to Money Marketing's website to secure your seat at our industry-leading event and hear from notable figures in the industry. See you there. Today, I'm joined by Andrew Aldridge, partner at Deepbridge Capital. So, Andrew, if you'd like to give a better introduction of yourself and let us know more about you.
It was factually correct. That was good. Thank you.
It was.
Thank you, Kimberley. Thank you for having me. So yes, I'm a partner and head of marketing at Deepbridge Capital. We are a tax-efficient investment manager. We specialise particularly in EIS, the Enterprise Investment Scheme, and we also have a business relief proposition. So that's kind of our area. They are funds that we promote to IFAs.
Okay, great. So how did you get started in financial services? I know that you're on the marketing side, but
Sure.
What was that path?
Good question. So I did economics and marketing at university. Came out of university, realised that marketing was what I loved doing. And my first job at university was working for a law firm that specialised in conveyancing. So I was heavily involved in the mortgage market. So that was kind of my first foray into financial services. We were promoting ourselves to mortgage brokers, IFAs, etc. So that was kind of for longer ago than I care to imagine. Over 20 years now. So I've always been in and around financial services, whether that be working for law firms or more latterly before Deepbridge, I was working for a national IFA group called Perspective. So I was there for nearly 5 years, growing that business. And then I joined Deepbridge back in 2014, which seems only like yesterday sometimes, but it seems like a lifetime ago at other times. And it was really that I met Ian Warwick, who's the founder of Deepbridge, and I was taken aback by his passion for supporting early stage companies, and EIS was really the mechanism to raise the funds to help those early stage companies. So it was a nice tie-in from kind of the financial services world into the venture capital world, which is fascinating, and it's a very easy subject to get very passionate about. And it's been a great journey since.
Yeah, it does sound like you've been able to move laterally and just absorb a lot of different information, because obviously moving from kind of mortgages to investing, I think is there anything that you've been able to like transfer across, or has it been completely different?
There's obviously in marketing there's commonalities, there's common themes, and the two things that I always talk to everyone, and I've done things with IFAs before, kind of helping them grow their businesses and things, and it's two words: a consistency and persistency. If you've got a clear message that you can get across and you regularly tell it in a constructive manner, then that's how you gain business and that's how you grow a business. But then within the financial services and legal worlds that I've been working, there's so many similarities. I mean, you're wanting to work out what the financial advisor needs in order to get the great products for the client. So it's working with advisors to understand their problems, their challenges, understanding what the clients want, and then making sure you've got products that fit that need. Anyone can run off and design a product and it not be fit for purpose. The important bit is to make sure that the product is fit for what the client wants, and that's ultimately what the advisors need in their toolkit.
Right. That makes a lot of sense. So when you're kind of talking to advisors on how to grow their business, what is your approach? Do you kind of ask them about what their clients want, or is it just what their personal goals might be?
It's a mixture of both. Ultimately, IFAs will generally have a long-standing client bank, so it's understanding where they are in their journey. Are they in the accumulation phase? Are they in decumulation phase? What's the average age of the client? What kind of products they might be able to fit that. And then secondly, it's what does the advisor want? Is it that he wants more clients, or does he want higher net worth clients? Does he want more cash coming with less clients but more cash? And it's the old 80-20 rule that, you'll probably get 80% of your business from your top 20 clients. So it's kind of understanding, okay, everyone wants those top 20 clients. So how do you go about finding those individuals? How do you make sure you've got the products to actually service those clients? So for example, particularly working in the EIS world, which is all about tax efficient investments, it's traditionally been for the higher net worth clients. So actually, if you are an advisor wanting to work with high net worth clients, you need to be talking about EISs, VCTs, business relief, etc. These are things you need in your toolkit. If you're not talking about these products, you're not going to attract the high net worth clients that have tax needs, have a desire for early stage investments and long-term growth. So you've got to be talking about these products if you want to grow that side of your business.
Yeah. Well, that makes sense. And since you mentioned kind of tax efficiency, investing in a tax efficient manner seems to be more crucial, especially for investors who wants to minimize risk and maximize returns. So what would you say investors need to do in that capacity?
Sure. I think first and foremost, we have to, investing in tax efficient investments such as EIS and VCT, they are investing in unquoted early stage companies. So therefore there is risk. There is a high risk, with those companies. However, having said that, that is why the government offers significant tax incentives to encourage people to invest in early stage companies. So under EIS, for example, you get income tax relief. So up to 30% income tax relief against your investments. So if you invest £10,000, within a few weeks, you can be claiming back 30% of that against your tax bill for that year. You can also defer a capital gain. So if you've recently sold a business or sold some shares or sold a property and you've got a large capital gain, you can defer the tax payable on that until the end of the investment. All growth is tax-free. There's no CGT on EIS investments. They are automatically business relief qualifying, so therefore they are exempt from IHT. So if you piece them all together, as long as you're an investor that has the capacity for loss and you understand these are high risk investments, actually if the tax reliefs work as they should do and you were using all of them, then there's very little actually money you're losing in terms of if the company goes the wrong way. You also got share loss relief, so you can actually claim against any losses you make. So ultimately, there's all these tax incentives from the government are there to try and minimize the risk for investors and to encourage people to invest in these areas. However, they are high risk investments. So you've got to bear that in mind. As long as the clients have got the capacity for loss, they could technically be covering all their cash back in terms of tax release on that money. So that's why the government have these schemes, is to encourage people to invest in early stage companies. So you've got to be having that appetite to do that. But ultimately, the tax reliefs are amongst the most generous in the world, and people should be really proud of what we've got in this country.
Yeah, no, I think that is a very fair point. And in this time of high inflation and low interest rates, that's probably something that would be beneficial to most people. But I'm sure there's probably some clients that might be quite jumpy, quite scared, reading or seeing, their certain investments drop dramatically. Do you take part in helping advisors in how they communicate with their clients? Because I feel like that's probably the key thing, is how they're able to communicate like this. It might look this way, but in the long term, it's going to be fine.
Yeah, you're absolutely right. And it's a great point. I think, we are in a high inflation world. Over the last few months, you've seen high volatility in the main stock markets. That spooks people naturally. Some is old enough. We've been there before. We know how it works, but it does spook people. And I think, counterintuitively, ultimately, things like EIS, they're not on the main market, they are unlisted stocks, though they are relatively uncorrelated to the main markets, and they're all about long-term growth. So ultimately, you should, if your product's doing what it should be doing, over the long term, and I'm talking 5, 6, 7 years, you should be able to beat inflation in terms of the returns you're getting on a good product. But that is counterintuitive to people. When things aren't going well, people naturally get cautious, sit on their cash, wonder what they're going to do with it, etc. And that's certainly been evident this year. Just talking to IFAs who are saying, look, we've got clients that regularly use EIS, for example, and they're saying they're just holding off for the time being, just seeing what's going to happen with the world before they do investments, etc. So, from that end, it's one of those things where actually, we know that humans aren't rational, and ultimately, in a world where you've got high inflation, where you've got volatility in the market, you arguably should be looking at these products even more so. But actually, people go to ground, sit on cash, when actually we all know that in an inflation world of 10%, the worst thing you can do is sit on cash because you're actually losing money in real terms. It's that counterintuitiveness and that kind of irrational behavior. But ultimately, like I said, these are high risk investments. They are illiquid because they're unquoted. There's not an easy market to sell them. So that's why people get nervous and kind of just sit on cash, just trying to see what's happening. But it is. I think if anybody's looking at the moment for long-term growth, there's not many better markets to be looking at than the EIS and the VCT market, because ultimately, for those reasons I've just mentioned, those are the markets that you're going to get the growth you're going to get. I don't think many people are going to beat inflation on their pension funds or their ISAs this year. That's going to be quite difficult. But these are the markets where over 5, 6, 7 years you could be making inflation busting returns.
Yeah. And is this something that you've seen happen since you joined in 2014? Are these conversations that you were prepared for?
Absolutely. I think one of the big things since 2014 that I've certainly noticed in our industry is advisor confidence in products like EIS has grown considerably. There's been government changes to EIS in that time that adds reassurance to what people are doing. There's more products in the market. There's more education in the market. There's great independent reviews in the market. There's great systems and platforms people can use for these kind of products now, which weren't there in 2014. So the market has matured massively. And I think more and more advisors are now getting comfortable with these products. I think there's still a large swathe who just discount them out of hand. And I think that's, like I said before, if you are wanting the clients that you think you want as an advisor, then these are products you've got to be considering and looking at, because ultimately these are the products that clients are going to want.
Yeah. Do you think that the reason why some advisors might not take it up is maybe their understanding of it isn't as in depth as they'd want to be, or the comms might be too much jargon? Is it something like that?
Yeah, I think there's confidence is a massive thing. I think, you've got to, as an advisor, let's say 10% of an advisor's clients might be appropriate to be using a tax efficient investment. And then out of that portfolio, you're probably a maximum of 10% is what most advisors will be putting into these. So ultimately for an advisor, that's 1% of their overall funds they look after is going to be in this space. So, but it's an area that you've got to understand. It's not simple. You've got to understand it. You've got to understand how it works. So actually advisors probably got to spend a disproportionate amount of time understanding the market, understanding the research, understanding how things work, how things move, how clients get their returns, how they make their tax relief claims, all these kind of things that they've got to get their head around. So confidence is a massive thing. There's so much good education in the market now. We run a series of webinars and events, etc. You've got organizations, lots of the compliance service providers in the market now run webinars, seminars, etc. on these kind of sectors. So there's more education out there than ever before. But the other two kind of things that advisors often push back on and say, I don't touch that. One is kind of a bit of a misnomer. They'll just say, it makes my professional indemnity insurance too high or something like that, which is kind of a bit of a misnomer. Most PI providers will talk to advisors and say, look, well, actually, if you do this, this and this, then you can minimize your risk, and therefore they're happy with it. And the third one, the other reason why the people are advisors are potentially put off by it is, that they'll just get, compliance won't like it. Compliance won't. And again, I think that's confidence. And again, it comes to that confidence. So that education, I think if people understand it, then they know how to have those conversations with compliance or with their PI provider or whoever it might be. And I think, your point is exactly spot on. It all comes back to confidence. The education, there's so much education out there. The PI issue is a bit of a misnomer for a lot of people. And the compliance service and the compliance checking is very much a misnomer. We work with all the compliance service providers in the market, and they're all very happy for people to recommend these products where it's appropriate, where it's the right client.
Yeah. And on that compliance issue, is there added paperwork with that, or is that just kind of a part and parcel of everything?
It depends on who the advisor works with. Whether it's a compliance service provider, whether it's in-house compliance, whatever it might be. So larger national IFA firms and some of the small ones will tend to have a panel of providers that they can use, where they've done their research maybe once a year or maybe twice a year, and then they roll that out to their advisors saying, if you're doing EIS, you've got these 6 managers you can use, etc. So it just kind of hones it down. In which case, if they've got the panel, generally there's not a huge amount, much more paperwork that they need to do. It's just crack on, but you're using a panel, so that's fine. But then there's other people that it'll be a pre-approval basis. So for things like this, it will be, you've got to get it pre-approved by compliance, in which case, again, that could put people off because do I want compliance kind of looking over my shoulder at what I'm doing and things like that. So it depends on how people are working. Like I said, a majority of compliance service providers we work with, majority of the national IFA firms that we work with, they're all very comfortable with this. They will have checks and balances, of course. They are high-risk investments, but they are very comfortable with this. And I think so that is, again, a bit of a misnomer that compliance won't like this. They do like it. And I think consumer duty rules coming out, etc.
Yeah, exactly. I was about to bring that up.
Yeah, I'll let you ask the question then, Kimberley. There you go. That's,
I was going to ask, I feel like with like everything that you've talked about, we're working with compliance, and it seems that it kind of ticks off those boxes of what the FCA have kind of laid out in terms of consumer duty, but you would know more than I would.
No, you're spot on. I think, consumer duty is all about client outcomes. That's that's the phrase that I think we're all sick of hearing now. Client outcomes. But you can't essentially disagree with the FCA on that. Ultimately, that is how you can recognise what good advice is. That's how you get clients with getting what they want out of the process, etc. So I think that's what you've got to bear in mind. Now, if you're an advisor and you go, I just don't do AIS, then how do you know that you're going to get the right client outcomes? If you're dismissing a whole raft of the market, you might have a client, for example, that suddenly sells their business and suddenly they've got a CGT liability, or they've got, or they do particularly well at work and suddenly they become a higher rate taxpayer. If you're just dismissing products like this, then you're not going to be meeting your FCA consumer duty rules, because ultimately you're not going to be getting the best outcomes to your clients. If there's mechanisms to get either long-term growth or to save tax, etc., then that might be what the client outcome should have been getting. So advisors can't dismiss these products anymore. And I think there's a majority of good advisors know these products inside out, know what to do with them. And I think but there are still swathes of people just go, no, don't touch that. Don't do that. And I think that's the market which is going to change. And I think there's got a lot of people are going to have to kind of re-educate themselves.
Mm-hmm. I also saw while I was doing my research that technology plays a part in what you do at Deepbridge. So in what way are you using kind of technology to help, whether that is with communicating certain aspects to advisors or what they do with their clients?
Yeah, so you're absolutely right. I mean, our EISs, we invest into two sectors. So tech, so we have our tech growth, our Deepbridge technology growth EIS, and we have Deepbridge life sciences EIS, which focuses purely on health tech and pharma and digital healthcare, etc. So on the tech side, so we are tech experts in what we invest in. How we use tech ourselves is that we're constantly evolving what we do. We're growing as a team, we're growing as an organisation. We launched our first advisor portal last year. And again, EIS is difference being in a fund. If you invest in a fund, you're in that one fund, and then the fund does the investing for you. With EIS, you invest in a discretionary service, and then we will invest you into multiple companies. So you will end up, so if you've invested in 10 companies, you will end up with 10 share certificates, you'll end up with 10 tax certificates, etc. So the portal that we've put together is really to help people manage that paperwork, because EIS is there's a lot of paperwork. So that's been a revelation. Advisors have given us great feedback on that, and we've been working with them. So much so that 2 months ago we then launched the client version, so clients can now access all the information, get their paperwork, etc. So for us, technology is hugely important. We see it in what we invest in, and the companies that we invest in. For ourselves, it's important that we keep ahead of the trends as well, and keep ahead of the curve, and make sure that we're using tech in the right ways for our clients as well.
And when you're looking for the companies that you invest in, what is that process on the tech side and the life sciences side?
So the process is very similar. We will generally see. So I think last year we saw something like 1,500 early stage companies. So that's ranging from startups, so spin outs from university, through to companies that maybe are making commercial revenues but still relatively small, so they're looking to raise £2 to £3 million, etc. And the exciting bit is seeing those companies. I mean, that is the joy of this job is we see tech ahead of its time. We see life sciences and drug discovery stuff ahead of its time. In the last few years, I think everyone in the world has learned what a vaccine is and how a vaccine's created and things like that. Well, we've been seeing that for years. We've been seeing those kind of companies doing those kind of things. So it's brilliant to see that. So once the companies come to us, they go through an initial screening process. So we do an initial review. Do they meet our own criteria? So we're always looking for companies which have got great intellectual property. They've got got to have a great team, and they've got to have global scalability. They've got to be able to work globally in order to get that scale and that growth we want. So once they've done that initial screening, it then gets reviewed by our team from a technology and a market size perspective. And then if it ticks all those boxes, then we go into deeper dive due diligence, which usually takes 3 to 6 weeks, where we work with them. We go under the bonnet. We look at all the individuals behind it. We look at their IP. We look at their markets, their customers, etc. And then once it's gone through that, again, if that goes back to our investment committee and they sign that off, it then goes into legals. And obviously, from our perspective, taking investment in these companies is that's a crucial part for us, because we've got to make sure that our investors' interests are looked after. So it's got to make sure we've got the right shareholder agreements in place, the right terms of reference, etc. So that's great. So generally, the process will probably take somewhere between 12 and 24 weeks in order from getting something we like look of through to actually getting cash into that company. So that's thrilling. But ultimately, we get our deals, and these kind of companies come to us from all over the place. So we've got people that come to us through professional connections, lawyers, accountants who are working with early stage companies, through to universities, and we are regionally agnostic. So we invest in companies across the UK. So we've got companies that have spun out of universities in Northern Ireland, in Scotland. We've got early stage companies down in Kent, in Wales. We've over last year, over 85% of our cash that we deployed was into companies outside of London, which is great. It's all part of the levelling up agenda. That's not necessarily on purpose. We're not excluding London, but there's so much great innovation in this country. We've got so much great academia. We've got great tech. We've got great life sciences. There's just so much exciting stuff going on, and it's in the strangest of places. We've got one company that's based in a town or city that you've never heard of called St Asaph up in North Wales. Okay. We've got a company, a great medical life sciences company that's based out of Aberdeen. We've got all these kind of things. We've got a great cancer diagnostic company based out of Belfast. So there's these things going all over the country, and it's that's for us. That's the thing to get excited about. We love seeing what the innovation that's going on in the country, and then it's our journey and our job to help them on that journey and work through to help them scale and become successful businesses.
Yeah. As a life sciences nerd, my background was in life sciences. Okay. I do get quite excited reading about stuff like that. Sometimes I do like to see, new innovations that are coming up. So I feel like that would be quite interesting for me as absolutely. Well. So finally, I guess, what would your advice be to advisors who want to give more proposals where investing in a tax efficient manner?
Yeah, I think first and foremost, I think they have to consider the investment, not just the tax. So you can't just do it for the tax. You have to look at the underlying proposition that you're investing in, understand the growth journey of what they're going through. And like I said, these are illiquid companies, they're early stage companies. So for some companies, it'll be a 3-year window and you're out. You'll be exiting 3 years and great guns. Some of these companies you might be holding on to 5, 6, 7, 8, maybe even longer into some of these companies. So you've got to understand the manager's portfolio, what their approach is, how they go about choosing their companies, how they work with their companies, and ultimately how they exit those companies. So it's really important for people wanting to operate in this space to understand the managers, understand their ethos. Are they good guys? Do you actually kind of, if you're spending, this is, probably most IFAs' best clients will be going into these products. So you don't want to be pissing off your clients. So, you've got to make sure the guys that you're working with, the managers, are guys that you trust and you understand what they're doing. And I think that's the key thing for me, is that you've got to understand the investment. It's not just about the tax. The tax is great, and that's the government incentive, and that's the government, if you like, risk mitigator in small letters. That is what the tax is there for. What you're really investing in is great early stage companies that have got growth potential and exit opportunities within the next kind of 5, 6, 7, 8 years. So you've really got to understand that. So I think it's great that people want to get into this space, but you've got to speak to the managers, understand what they're doing. There's more support out there than ever before in this market. There's better education, there's great independent reviews, there's great software and platforms to help you do this, but you've got to understand what you're investing in. It's not just about the tax. Yeah.
I think that is probably the first thing. Understand what you're investing in.
Absolutely.
Definitely. Well, thank you so much for speaking with me, Andrew.
Thank you. That was great.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.